Looks like the numbers are stable now. So welcome everyone. Great to have you all with us. I can see most of you have joined now, so let's get started. It's been an eventful year, increasing US investor participation, AI, private credit, just to name a few, so have reshaped the private markets landscape. So today we'll look at what 2025 actually delivered, why deal sourcing is shifting, what we discovered about Belgian family offices, and to close, Sophie's 3 main takeaways for 2026. 3 things every investor in the room should keep in front of mind going into the next year. And then we have 10 minutes of live Q&A. So drop your questions in the chat anytime. We'll get to them at the end of this webinar. Because the question on every investor's mind is, where is this market actually heading? We brought back the best person to help answer that question in this webinar. So hi, Sophie. Nice to have you back.
Hi, Steve.
So for those who weren't with us last year, Sophie is professor at Vlerick Business School, and she recently became the chair of Private Capital Belgium. So congrats on that, Sophie. So for those who don't know, Private Capital Belgium is the industry body for private equity and venture capital, previously called the BVA. You've been on the board a while, Sophie, of Private Capital Belgium. Now you're stepping in as chair. How do you see your role changing, and what's top of mind on your agenda today?
Well, Steve, thank you for the question. First of all, Private Capital Belgium has a little bit a broader perspective compared to the former BVA, given that we include all types of private capital. So we also want to include family offices, which are an increasing force, as you're going to show, private debt, you name it. Okay, so private capital is broader currently than just private equity and venture capital.
Yep.
And what I would like to really focus upon during my chairpersonship is that I would like to get better access to better data on what private equity, venture capital, private markets in general, what they represent in Belgium. Okay, so how important are they for the Belgian economy?
Okay, great. And we've been discussing that, Sophie, so we'll try to collaborate on getting a better view of what private capital means in the Belgian market. Perhaps a quick word on me before we get into it. I'm Steve Duplassie. I'm managing director of openthebox. What we do is we turn right now Belgian, UK, and Dutch data into actionable insights for banking and investors. We recently, as Sophie mentioned, published the Belgian Family Office Monitor. We'll come back to that later. But now, for the person you're actually here to hear from, Sophie, this is the picture from PitchBook on what private capital has been in 2025. You lived through this year from both sides, both as a researcher and as active in the boardroom. What actually played out as expected according to you, and what genuinely surprised you last year, Sophie?
Well, first of all, the general trend is not necessarily the Belgian trend. Okay, Belgium is a small drop in the global private equity, private markets ecosystem. Mm-hmm. But the big ideas remain the same. First of all, you say we see exits, modest recovery, very modest recovery. What PitchBook claims to be a modest recovery is also driven by some IPOs. Let's not forget the Klarna IPO, which was huge last year, just distorting all the European statistics. We don't have Klarna yet in Belgium. Let's hope it will come at some point in time. So we have seen almost no IPO, only one from Energy Vision. That's it. So definitely IPOs did not rebound in Belgium. And unfortunately, looking forward to 2026, there apparently allegedly are some candidates in the waiting room, but still out there. Okay, are we going to see any? We are already April, and activity is still not picking up yet. Fundraising under pressure, yes, absolutely. Also for Belgian private market funds in general. While we did see some successes, think about the Waterland Fund, technically a Dutch private equity investor, but also very active in Belgium and across Europe. They have a record fundraising behind them. Hummingbird, for example, technically located in London, so this already means something. Technically located in the Netherlands, the UK. We don't have them in Belgium, unfortunately. So the very big players in their segment, the very successful players have been able to do successful fundraising. But we do see many partnerships who really struggle. We have seen quite a number of new funds raised, which were below the volume of the previous funds, which is a sign that fundraising is really difficult. Because in the good times, new funds are typically larger than the previous funds. Fund sizes tend to increase. We have seen quite a number of funds that closed below or at par with the previous funds. So showing that really for the average fund, fundraising is still very, very difficult.
Okay, and do we see a reason for that? Because interest rates have dropped lately, so you could imagine that kind of fundraising would become easier for private capital. Is there something I'm missing or something we're missing?
Yeah, interest rates are obviously extremely important for the private equity segment, less so for venture capital, which is less driven by debt. But private equity definitely is. So it's the macro environment from that perspective is getting better for private equity. But it is tied to exits. Many institutional investors have their allocation towards private market funds. And if there's no exits in the previous funds, then their allocation is still inflated and they have no liquidity to reinvest in new funds, which is disturbing. So, and still institutional investors are not an important part of the private markets universe. Okay.
And if we take your message and you say, okay, let's look forward at 2026. So your message is the headline numbers look strong. There's some big exits, some big IPOs, record deal value according to PitchBook. I don't know, 650 billion, I think, in 2025. AI is booming, but if you strip out the mega deals and let's say AI, and the picture looks much more mixed, if I hear you correctly. Is this a real recovery according to you for the broader market? Or perhaps my question is, what number or metric are you following to see how 2026 will evolve? Kind of what is the canary in the coal mine metric according to you to see how 2026 will evolve?
Impossible to come up with an answer to your question, Steve, because we're not talking about one market. It is becoming more and more a diversified market. What we see in private equity, mid-market private equity, for example, has nothing to do with early stage venture capital. Okay, so what happens in the one market is absolutely not correlated with what's happening in the other market. Other dynamics, other underlying pressures and opportunities arising. So there's definitely not one metric that I'm following.
Yes.
But that being said, the classical metrics of fundraising, definitely, you need money to be able to invest, and exits and performance. These are the classics, which remain highly important, obviously, driving this industry forward.
Okay. Perhaps one additional question, and Ali, what stood out for me in the PitchBook study is that 1 in 4 European private equity deals involve US sponsors, so US capital. And they even kind of look at it that it will increase. I think last year it was 1 in 5. This year it will be 1 in 4 according to PitchBook. How should current private equity in Belgium, let's say, adapt their position, or how should current private equity in Belgium react to that? How do you see this?
Yeah, I see this as an opportunity because we also saw in their statistics that US private equity investors, the increase there was mainly in mega deals.
Yes.
Okay, so obviously they're also active in the higher mid-market segment and much less active in the lower, smaller size brackets, obviously, given transaction costs, given information asymmetries, etc. So this only implies that if more US investors are looking at Europe, more mega deals will become feasible in Europe as well, which were currently lagging behind. So I see this as an opportunity. Is it a threat for our Belgian funds? We have few mega funds in Belgium chasing mega deals. So Belgium is really a country currently of small and mid-sized transactions. The mega transactions, well, so for the mega companies in Belgium, this offers additional opportunities.
Okay. And perhaps for the investors in the room, if 2025 taught us anything, what's going to separate the funds that have a good 2026 versus the ones that will have a bad 2026? Is there anything you can share on that?
Again, a difficult question, Steve, because a good 2026 or a bad 2026, I don't like to talk about returns. And if you talk about good and bad, I probably refer to returns. Okay. You can do that for quoted companies looking at the performance of 1 year. But in private markets, we're not looking at 1 year performance. We're really looking at the medium long term. So what happens over the lifetime of a fund? So you may be in a down at some point in time, but then rebound before the end of the life cycle of a fund. I really find the 1 year returns not so informative. I'm not saying completely irrelevant, but not so informative. What we do know from history, Steve, is that fund vintage year really matters. So raising a fund when the markets are really hot, like in 2020, 2021, typically these are the vintages that performance-wise are not doing so well. Because competition is so big, you see it, huh? So there's a lot of dry powder, there's a lot of competition for deals, etc. So a lot of money to be invested from those funds that have been raised, the giga funds that have been raised in hot markets. Nowadays, fundraising is under pressure. This is the moment to continue to invest. Okay. Lessons from history, and I still think that history is relevant given the very cyclical nature of the market. Dare to invest when others are pulling out, because there's less competition and there's still good opportunities. Opportunities in the venture capital space, for example, are very often technology driven. Technology does not wait for external markets to be flourishing. Technology emerges, and definitely nowadays, obviously with AI all around, we're just seeing hordes of new opportunities abounding. The energy crisis still points out that there's a lot to do in new tech for energy management, etc., etc. In turbulent times, there's a lot of opportunities. So continuing to invest in difficult times might be a winning strategy. So I do think that funds that are set up last year, this year, if well managed, and if they're able to capitalize on those real opportunities, have all the chances of doing well.
Yes. Well, let's shift gears a little bit, because you talk about AI as an investment opportunity, but in our pre-discussion, we also talked about AI as an operational topic for private equity and VC in the deal sourcing part. So at Open the Box, we've been thinking a lot about deal sourcing, about moving from reactive outreach to signal-driven sourcing and proprietary views for the private equity, and kind of doing better in doing so. And AI is what makes this shift probably possible at scale for private equity, which means it's no longer optional for private equity firms, I think, to use AI. It's becoming part of how the work actually gets done. Sophie, leaving opportunity on the table when it comes to deal sourcing. And is AI really changing how they source in practice, or is it still kind of a storyline that doesn't have a lot of practical impact in the day-to-day?
Steve, as very often in this space, innovations come from the US. So if we look at deal sourcing between brackets there, what we do see currently, and this is really new and very exciting for me. I've been looking at this industry for decades now. I've never seen that. In the past, entrepreneurs had a great opportunity in mind, developed that, and went to see investors to finance their opportunity. What we now see in the US is that there are investment teams sitting on a pot of money, a nice fund. They're not waiting for entrepreneurs to come up with an opportunity, but they, knowing the market, knowing the opportunities in life sciences, in AI, in whatever, they say, hey, we want to build a company in that specific niche. And we're going to source that technology from wherever the best technology is to be found. And we will build a team around that opportunity.
Yes.
So it is currently, what we now see is investors shaping opportunities, putting together teams to develop a new company that obviously they're going to finance as well. Yes. And that's completely reversing the cycle, the logic. It's exciting. And in the past, that was not possible. But now with AI, indeed, you can scan the markets for the best technology, for the best people, for the best teams.
Indeed. I even found... Sorry, go ahead, Sophie.
No, just an example that is revolutionizing potentially how the way forward.
Yes. I even found a stat online, and it sounded interesting to me. It's from Chatfin, which is a vendor, so you could have some doubt on kind of the foundations of the research. But what they say is that proprietary deals, so deals where you go and find your deals yourself, you don't just kind of use public databases, or you don't wait until the deal comes to you, have a roughly 1.8 EBITDA discount, so multiple discount, versus the classic way of working. So there's also a business value in kind of finding your own deals, because you have lower prices, you can pay for lower prices. I thought that was an interesting statistic. I just want to refer to your own research, Sophie. So your research has shown previously that ownership transitions and governance dynamics matter a lot to PE outcomes. That's what you have written. If those signals are now more public and using AI can be surfaced a lot easier, does it widen the gap between firms that use the data well and those that kind of still don't use the data well?
Highly important question, Steve, because I really do think that we're just at the very scratching the surface of what AI is going to do with organizations, and all organizations will be impacted. And there will be winners and there will be losers, obviously. Yeah. So the name of the game will be to be able to transform data into actionable strategies and winning strategies. Absolutely. Yes. Data is the new gold, and using the data wisely, proprietary data, preferably, obviously, because if you trade on market information, others may also repackage that in one way or another. Yes. Combining market data with your own internal data. If you have good internal data that you match with the what's happening at the outside market data, some firms, some organizations will be much quicker to do that very well, and they'll probably be having really a head start compared to others.
Yes,
and will be ahead of the crowd.
Okay, and we talked about the Family Offices Monitor that we published about 3 weeks ago, and that's for me a concrete example of what proprietary research can surface. So 3 weeks ago, we indeed published the first what we call quantitative research on family offices in Belgium. We did this together with the TED. It also got published in the TED 3 weeks ago in the weekend. And the results, frankly, surprised us. We found 99 active family offices in Belgium, which was kind of before never, at least not to that level, kind of indexed. And together they hold about 43 billion in equity, about 36 billion in financial active. Of course, they don't publish their assets under management, so we had to use a proxy of financial assets to see their to value their size. And there's a striking concentration. About 14 of those 99 offices, the ones that are above 1 billion, hold roughly 50% of that equity. So the market is fragmented in numbers. You have 99, but very capital concentrated in a few, 14 of them at the top. But for me, and you kind of mentioned this before, the real story was in the growth that we see over the last 12 years. This market has tripled, which is enormous, and it's not slowing down. If we kind of continue the same growth path as they have done in the past few years, they will be at about 80 billion in 2030. So 14 of those offices were set up in 2020 alone. So they're very recent, with nearly 12 billion in capital. So they're still investing. They're set up kind of in the last 3 to 4 years. So they still probably have a lot of dry powder. There's even a lot that have been created in the past year. Partially intergenerational transfer. So kind of father giving them to the children or to the family, but also partially a few industrial exits. And as a West Flemish myself, most of them were concentrated in the west of Flanders, at least the new ones. Sophie, with 43 billion mapped now, family offices are big enough to compete probably with mid-market PE funds for the same deals. Imagine.
They do.
Are they becoming competitors, partners, because they have a different investment thesis, they have a different timeline, they have a different organization, perhaps a little bit less professionalized, I don't know. How do you see kind of the matching between family offices on the one side as private capital and private equity on the other side?
Yeah, I find it a very highly interesting and important new evolution. Yeah. Not only in Belgium, but worldwide. We see the same trend worldwide. And personally, I think this is just the beginning. It's not like we have seen the end of the growth curve there, because more and more companies are being exited, are being sold. So what do you do with that wealth? You set up your own family office, obviously, or you pair it together with other families to have a multi-family office or whatever. Are they competitors? Are complementary to the private market, the professionally managed private market funds? Well, as long as the market is not saturated, there's place for more funding. Okay. Yeah. And there may be pockets where indeed they are and they definitely are head-on competing for comparable transactions. But I do feel that the Belgian market, I'm talking about small caps, mid caps, not the mega transactions. That's a different ball game. Again, we don't have a lot of that in Belgium, so let's not talk about those. But I do think still that there's a lot of opportunities. It's not my impression that the market is flooded with too much money at this point in time. Okay. So rather than calling them head-on competitors with professional managers, for me, they're much more partners. Yes. That does not imply that private equity firms may complain that they lose some of their deals to some family offices. Yeah, obviously, but they could also have lost those deals to other private equity investors. Huh? Of course. We do see that indeed family offices target very comparable targets as private equity. So they've learned to trade from the private equity offices, except for the fact that family offices tend to invest closer by, okay, for their direct investments. Yes. They also indirectly invest in private markets through funds, through professionally managed funds, So there they are LPs, so they're definitely partners of the private market funds and professionals.
Yes.
But for their direct investments,
Yes.
they are investing in comparable companies, but closer by. So they're targeting comparable industries, ages, size, brackets, etc., etc.
Okay.
There's opportunity for family offices there to differentiate a little bit more from what we do see professional players doing, because they have a longer term perspective. They do not have the closed-in structure of the professionally managed funds, of most of the professionally managed funds. They have slightly different objectives as well. They have their idiosyncratic investment thesis. Okay, so they're only accountable to themselves.
Yes.
So that enables them to be a little bit more creative investment-wise. So I would welcome to see family offices investing in those type of opportunities that are not top of mind of private equity, capital, the traditional players.
Okay, clear. One other thing that surprised me, and you touched on this, is the operational kind of excellence part when it comes to smaller private equity versus bigger private equity. When we look at the family offices, so the largest family offices, they compound at about 13% per year, while the smallest at 4.3%. So you see kind of a very different growth path between the larger ones and the smaller ones, probably due to their expertise, their focus, the teams they have built around them. Do you see the same in private equity, that kind of the largest private equity grow faster, have better numbers, or is this something you haven't remarked yet? Okay.
No, you're right, Steve. First part that larger family offices definitely have a competitive edge compared to the smaller ones, because doing direct investments again is very still now, even with AI emerging in that industry, it's still quite a lot of work for professional managers. So you need a team to do that well. You cannot do that behind your desk just like that out of the blue. You need a team to do that. And you can only finance and hire a team if your family office is big enough. So there I really do see a competitive advantage for the big family offices who can compete with the professional private market funds. Okay, smaller family offices, which according to your research are the bulk of the family offices, they can easily build easily between brackets, build a portfolio as a limited partner investing in private market funds. Direct investments, there I would definitely advise them to stay close to what they know best. Okay, if they have an experience in life sciences, further invest in life sciences. They will be able to analyze that themselves, but do not wander into far away fields, far away industries where deal sourcing is much more challenging because they're not known, they don't have the network. Screening and selection is much more challenging if you do not have the fine-grained insights that you have gained through experience in your previous life as an entrepreneur or family firm owner or whatever. So you can still have an edge in direct investments if you are smaller than specifically when it's close to what your experience.
You already know. Okay. Thanks a lot, Sophie. So next up, 3 things to keep in mind for 2026. We asked you, Sophie, to kind of give your 3 takeaways, the main things that investors need to have top of mind in 2026. Could you walk us through them? What should every audience keep front of mind for the rest of 2026? Basically?
We already briefly touched upon the themes. The first one, I'm a strong believer in that, is that invest through the cycle. And I want to repeat that and stress it again, because I feel when talking to people, when seeing what's happening, too many people say, private markets, it's so illiquid, you have to wait so long to get your money back, we have no exits, there are no distributions, what's going to happen? And we do see LPs that entered for the first time in the end of the previous decade or beginning of this decade, getting very, very impatient and say, I'm just saying, this is not for me anymore. It takes too long. Yeah. Okay. And there I would say, continue to invest. Invest through the cycle. Okay. Yes. This will really help you to build a well-balanced, well-diversified portfolio that hopefully will also generate a nice return in the end. Yes. Do that with money that you don't need immediately. It is illiquid. It is an illiquid asset class. We cannot turn an illiquid asset class into something liquid. And yes, it takes long. We have an emerging trend of secondaries, which are also on the rise, helping to create some liquidity. But we would prefer to see real exits at a higher scale. But so invest through the cycle. Do not pull back because you say we already have all those funds that we've invested in and we don't get our money back. That would be a really, really, really bad strategy.
I agree. I used to work in private banking, and this is also the advice we gave to retail investors: kind of stay in the market even if it goes down. You know.
Yeah.
If you
and
stop,
this is the advice not only to retail investors but institutionals, whatever. And I do know that institutionals have their asset allocations and their ratios that they have to adhere to, and min, max, etc. I hope that they will be able to continue through the cycle. Okay.
Okay. Thanks a lot for that. Your second advice.
Second starting point is access and selection.
Mm-hmm.
So you, as a professional investor in direct markets, you can only have nice performance if what you're investing in has the potential to create value. And creating value is indeed access and selection. Access, Steve, you rightly noted that proprietary deal flow is so much more interesting compared to all the auctions that we currently see. And in the past, we only saw auctions for the mega deals, and obviously auctions became more and more the way to access private equity, mainly for smaller and smaller and smaller deals. Still, if you are able to have a head start and access deals that no one else has on their radar, not because the quality is not good, because they're just hidden. It's an information issue. Not all information is equally available to everyone. So having direct access to good quality deals is going to be still part of a winning strategy. And then selection, obviously, you still have to be very selective. It's not because you have a lot of dry powder in your previous funds that you just have to invest. Something that we also see happening, investment managers becoming nervous because they have raised all that capital. They need to put it to work. They may not always have the best opportunities to do so. That would be a recipe for a non-top quartile fund performance. Let's put it that way. Okay.
When you talk about access and selection, Sophie, you talk about it from a GP perspective. So finding the right deals and having access to the right data and the right deals. What about the LPs in the room? So let's say family offices and institutional investors and even the smaller PE firms, as you said, that should rather be acting as an LP and not as a GP. How do they apply this principle?
Excellent question, Steve. Excellent question, because they also have to select that. Yes. And research, international research, has shown that top quality institutional investors outperform others thanks to their possibility to select the best funds and the best teams to invest in. Yes. So as an LP, once you have invested, you're locked in. So selection is even more important, especially since returns in private equity and venture capital are quite dispersed. Being able to invest in the top quartile funds makes a huge difference compared to being at the bottom quartile. So
Yes.
selection is also for them
Yes.
a key issue. Access is also important.
Yeah.
If you aim to invest in local teams, typically they will knock on your door. Okay, local teams will know all players, potential LPs with big pockets, and they knock on all the doors. Yeah?
Yes.
However, if you want to access top quartile funds in the US, in Asia, you name it, that will be a different question. That's quite challenging. And there you might have to go through gatekeepers, to fund of funds who have access, or through intermediaries who have access. Those top quartile funds, they can pick and choose their own LPs. So you want to be among them. And it's not, so private equity, private markets is also an access game
Yes.
for LPs.
Agree. Okay, let's go to your third advice or things to keep in mind.
This is not only a takeaway for this year, but this goes along through all the cycles. Win on operational value creation, hugely important. But what is different currently compared to what we have seen the past decades is the importance of AI, operational value creation in traditional companies. Well, the playbook is out there. Okay, if you want to do it in a traditional way, you know what to do, optimize your working capital, optimize your free cash flows, whatever. People know the drill. So
Yes.
the industry has become much more professional. People understand what they should do in each of the different stages of the life cycle of a company.
Yes.
What is new now is how AI will impact how efficient companies can become. Okay, and again, we're just scratching the surface, but being able as professional managers to introduce AI in the operations of portfolio companies might be a tremendous game changer for those companies, if they're not able to do it themselves, obviously, but that goes with all the elements of the playbook that are out there currently. So operational value creation with a big focus on how AI can enhance operational excellence.
Yes. Okay. It's difficult to have a kind of a discussion on 2026 private capital markets without talking about kind of private debt. So I have perhaps one last question for you. When you look at the private debt markets, I think we have seen a real liquidity crisis. You know, the blue owls of the market that had capped their redemptions. How do you see the impact, Sophie, on the broader markets? You know, with all the private equity family officers in the room, how should they think about this forward?
Yeah. It's a multifaceted question that you're asking. We do see that private debt has grown tremendously over the last decade after the global financial crisis, when banks were really scrutinized and they got all kinds of Basel III agreements that they have to adhere to, and the Dodd-Frank Act in the US, so they could not operate as they used to operate. So they left a part of the market that has been filled by private debt funds, and some of them have been hugely successful, generating extremely nice returns for their LPs. We do not see that same type of activity in Belgium. So if you're talking about Belgium, the private debt market, private credit market has not developed. Okay, you do see private debt being active in the UK, in the Netherlands, in France, in all our neighboring countries, not in Belgium. Why is that? Because we have such a well-functioning banking market. Okay, so after the global crisis, banks are really giving still a lot of credit to our local companies. Okay, so there's less room for private debt to come in. Now, if you invested in private debt internationally, You might have been exposed to the problems that we have read about in the newspapers. There you have to distinguish. It's all labeled private debt in the press, but underneath you have different structures. You have the structures like private equity funds that we all know, 10-year lifetime. And if you get into that kind of structure, you should not ask your money back. You have to wait until you get distributions from the fund. You know, it is inherently illiquid. What we have seen, however, is that more and more of those structures have been repackaged as semi-liquid and offered more strongly towards retail investors. And this is where I start getting scared and where we have seen the issues popping up. Okay, semi-liquid, offering the possibility to ask for repayments, but repayments in the small print has never been guaranteed, which is quite logical because it is a maturity mismatch that we see there. How can you offer quarterly redemptions if you invest in underlying assets that have a long-term maturity?
Of course.
A maturity mismatch. So this was an accident waiting to happen.
Okay.
So I'm not really a fan of those more liquid, semi-liquid structures. They're not promising daily liquidity and they're very cautious, but you have to read the fine print. I do think that private debt in the traditional form with closed-end funds, it's there to stay. Yes. Will it still grow as exponentially as we have seen the last decade? Probably not, because it started from zero, then all the growth is exponential, but it's there to stay. It fills a gap that banks have not been had to withdraw from, and they have created their own capabilities beyond what typical banks could offer. So yes, it is again making the financial markets more complete.
Okay, clear. And indeed, as you say, reading the fine print, which is okay when you talk about bigger players, they should be able to read the fine print. But when you start selling private debt to retail investors, then it becomes a bit more difficult and more risky.
Yeah.
Okay, thank you, Sophie, for these interesting insights for our audience. I hope they have something to take with them and start off on a good year. We're now going to move to the Q&A. So I've read through the Q&A. We have multiple questions. There's a lot of practical questions, and I think your ambition, Sophie, to be more data-driven as Private Capital Belgium will come in handy, because there's a lot of questions about data, of where can we find this data, where can we find that data. So we'll come back to this. I have an interesting question here from Greg, who posted, it seems that currently we have a challenging economic environment where the quality in the market is subpar as right now, at least the deals that come through advisors. As of right now, there seems to be a gap between the valuation that owners have in mind, of course, and the price worth paying as an investor. How do we, as an investor, can get access to those better deals? Don't want to waste dry powder, but do want to do good deals, Greg says. So what's your view on that?
Yeah, Greg, indeed, I recognize the problem that you are pointing at. And this is a phenomenon that we have witnessed in the past as well. When markets cool down, entrepreneurs wishing to sell still have their memory of the good times where valuations were higher, where transactions took place at higher multiples, etc. And so they have difficulty adjusting their own mental models to the lower price levels that are now out in the market. And what we do see, the markets break down. There's fewer deals done. I would definitely not suggest to overpay. Okay, because probably the markets were overheated a couple of years ago, and we now see that investors that paid high prices a couple of years ago may get into trouble right now. So that's not my advice. The issue is that entrepreneurs wishing to sell, if they don't like the price And if the underlying company is doing well, they can wait. Okay, they can wait for 1 year, 2 years, depending on their time horizon. They are not under pressure to sell. If they're not under a pressure to sell, you cannot force them to sell. Okay. So where do you find that? I would look at industries that are really being disrupted. Okay, where you do see that traditional, nice family-led companies may have a trouble to adjust to a new reality. Okay, and maybe they may not see it right now that their industry is disrupting, but maybe they will start understanding that, oh, something is happening here. And my competition is not my local competitor anymore, but is global or is through a private equity backed player who has other dynamics, etc., etc. So which are the industries that are currently being disrupted where the traditional companies are not strong or not strategically oriented enough, or where just the timeline of the current family, the current owners, are not such that they are willing to invest and take a lot of risk to turn around the company to adjust to a new reality.
Okay.
So again, private access is really important there.
Indeed. Thanks. I have another question from Philip. Which do you think is more important in PE acquisition? Is it selection or deal terms?
Selection. Okay, so selection is key. With deal terms, you can never make up for a bad selection. If you have a bad company, assuming that you would select a bad company, but a less qualitative company with strong deal terms, you can never turn that around. Okay, so for me, selection would be key. Absolutely.
Question from Ken, and I should refer because we talk about valuation, Sophie, but I think in the next few days, your new M&A monitor or new M&A monitor will appear. So we have, and I'm very curious to see how the multiples will have evolved versus last year. We'll see tomorrow. I think tomorrow there's the first release of the M&A monitor. So for everybody interested in valuation, there's the M&A monitor from Vlerick, where you can see, according to the industries, according to the size of your company, what are the valuations. And if you want to have more information, we also offer those valuations in Open the Box per company. I have another question from Ken. How should, and it's again kind of focused on valuation. Everybody's very interested in valuations, of course. How should SMEs best prepare for the best possible valuation and attracting a large buyer pool? So what should an SME that's interested in selling its company kind of do to increase valuation and increase the number of potential buyers?
Yeah, attracting the bright is important. It has always been important. It is still important, and it will remain important. So make sure that the company in itself is professionally managed. Professionally managed, has a lot of information, has a lot of data to enable a quick and efficient due diligence without surprises. Okay, potential investors do not like surprises, so its information should not be in the head of the entrepreneur, but should be visible and transformed in data. It's again data, hugely important, but also professionally managed. Make sure, well, it's a traditional advisor. Make sure that the company does not hinge on just one or two key persons. That if the company is sold, that they are also going to leave. But make sure that you have a professional management team, which is very often lacking in SMEs. Very often lacking, which also makes that seeing through the companies, understanding what the company stands for, making that much more difficult. So make it future-proof and resilient. It's the traditional issues that have been around for ages and are still valued. But yes, many SMEs do not understand them yet. So prepare your company, make the company as professional, data-driven, efficient as possible.
Okay, thanks a lot. Hope that's good advice for everybody in the room when they're planning to sell their company. There's a few questions also on the Family Office Monitor I can reach out. One mainly is how the selection has been made, because we say 99, which is perhaps a low bar because there's probably more in Belgium, but the selection we made, there's no kind of indicator this company is a family office, so you have to take into account some context. We made some quantitative selection, of course, on holdings. So we said, okay, we're looking for holdings mainly that have certain criteria that don't have a real activity. So not a lot of work FTE in the company, because then when you have larger FTE sizes, you probably have a company that is still actively providing services or products. We also made a selection broader, so we looked at press releases, we looked at press in general. Is there any reference towards family offices in the press? And then we looked at ownership, because of course a family office, you can have holdings that match the criteria but don't have a family as their owner. So then we looked at ownership to see if there's a family above. Mostly it's father and kids, or father and husband and wife that are kind of at the source of the company. So that's how we made the selection. And then we had a review with the data, because of course they know the market. They have been writing about the family office market. They have been writing about entrepreneurs, so they know the market very well. And then we made a selection. We also excluded family offices that only have what I would call classic activity, so still have their kind of their own companies as a participation, so that are not enough diversified, I would say. So there's not one rule that says, okay, this is a family office. We try to be as complete as possible, as quantitative as possible, and then based on that, made the selection together with the data to have kind of to land on the 99. But it's something we will do regularly. So we will update the Family Office Monitor, having new numbers, potentially finding new family offices in the market, so we can kind of expand on the current Family Office Monitor. Okay, Sophie, we have a few more minutes. I'll see if we have additional questions. Another question by Greg. Greg is active in the Q&A. How do we look at an evolution of corporate VC? Invest as an established company in tech startups to become preferred partners and get tentacles into new trends or financial upside. How does one approach that without having that VC background? So as a corporate, investing in smaller startups, so acting as a VC as a corporate. How do you see this? How does a corporate approach this or those deals? Not having the background as a VC, not having the expertise as a VC, of course.
Yeah. This is corporates have been around for since the years 2010 approximately, and obviously you had corporates that were busy earlier in venture investing, but that became then really a trend. And they do have different objectives and goals compared to independent VCs. So they definitely want to have a window on technology or some strategic advantage that for financial investors is less relevant, obviously. How should they find and approach those deals? Build your network, and there they do have a competitive edge compared to financial investors, compared to independent VCs, because they know the trade shows, they know they know their industry, they should know what is happening in their industry. They should have ties to research institutes that are relevant for their activities. So build those ties and go actively where you see hubs of new entrepreneurs and entrepreneurial companies originating and working together. We do see that very often entrepreneurs positively view that kind of corporate investors because they understand the value that they can get from them. They hope to get industry knowledge or specific resources that those big corporates have that they don't have. access to information about what's happening, what they find important for customers, etc., etc. So corporates who really develop that strategy to invest in venture capital, early stage companies, it is exciting and it's absolutely feasible. Just do it. I would suggest to co-invest, especially in the early years when you have no experience yet. I definitely would urge to co-invest with independent VCs to learn the trade, to learn how things work, okay? And to leave sufficient room to those independents to engage in their typical strategy. Take a seat back, see what's happening, learn, try to be active with a portfolio company when you can, when you have relevant expertise, relevant resources, capabilities, given your corporate background.
Yes.
And many corporates have done quite well, indeed.
Okay, indeed. So it's very recognizable for me because we, as openthebox, are also part of a corporate. So we are kind of an investment of a corporate, being Mediafin, editor of the Tate. Sophie, I think our time is up. Thank you very much. Genuinely, the audience didn't come for our slides or me, they came for you and for your reading of the market. And you delivered as always, so thank you. To everyone in the room, replays in your inbox this afternoon. The Family Office Monitor is at openthebox.com, and you'll see us back in the autumn with new webinars. So thank you all for your time and see you soon. And thank you, Sophie.
Thank you for the invitation.
Bye-bye.